I want to invite Athanasia now because I think investors play an important role here, or could play an important role, right? Because all these companies we're talking about, not all, but many of them have investors. So there might be an angle here and responsibility for investors. So Athanasia, please welcome and give us a little bit of insight into the work you've been doing.
Thank you, Victor. It's really a pleasure to join this panel today. Thank you for the presentations and reflections. I have also put together a few slides just to help me take you through our own journey at the PRI, what we have been doing in the last few years, and what we think the role is for investors. So I think we can start sharing the small presentation I've put together. And in the interest of time, I will try to go through it fairly quickly so we can have some time for Q&A.
Appreciate it. Thank you.
Perfect. So if we can just move to the next slide. I actually wanted to start by briefly introducing the PRI. I'm not sure how much of the audience is familiar with who we are. So back in 2005, the then UN Secretary General Kofi Annan invited a group of the world's largest institutional investors to join the process to develop the PRI, the Principles for Responsible Investment. Now, from this beginning, we launched the principles in 2006. The PRI is independent, but it is also a unique organization in the sense that it is investor-led. It is an investor-led initiative, but it also benefits from the ongoing support of the UN. And we try to put the 6 principles for responsible investment into practice. And I think it's a sign of how much this movement has grown, that we started with a handful of signatories, and now we have over 4,600 members. I think it's more than that now, representing assets under management over 120 trillion US dollars. And a very significant portion of that is in global long-term savings. Now, our mission as the PRI is to help create a sustainable financial system. And we do that by helping investors incorporate ESG factors into the environmental, social, and governance factors or issues into their portfolios and decision making. So I think a question that we've been asked quite a lot in the last few years is, why does the PRI work on tax? And why does this remain as a focus area? So if we move to my next slide, I wanted to start by highlighting briefly why this really matters to investors, including from an ESG perspective. When we first started our work on tax, we identified tax avoidance as a material risk for investors. So we started from the risk perspective. We think it presents governance risks, reputational, and really bottom line earnings risks for companies. It can also result in social and macroeconomic distortions, market distortions, which affect competition, the reduced capital available for infrastructure and development. And I think the pandemic has also highlighted this quite a bit. Given that the majority of value for our long-term diversified investors, and I'm talking here about big asset owners, pension funds, insurance companies, it's actually linked to market performance versus individual performance of companies. There's a very strong case, in our view, to prioritize a robust tax system globally. It should fuel economic growth and stability over short-term financial results and profitability. But my slide doesn't mention risks, because we are trying to change the narrative from only a risk perspective to actually show how investors can benefit from a robust tax system that is efficient and fair, both at the macro and micro level. So we're trying to move the discussion from just a risk perspective to a tax fairness perspective. And that's a very important step change. 7 years ago, when we started working on tax, we would not have used the words tax fairness, but it's a sign of how quickly things have moved that now we do comfortably so. Now, the fact is that while norms in the international tax system have started shifting, they're not ideal, but they have started shifting, progress from corporates and investors has not kept pace. So this could be in essence because boundaries around what is acceptable tax planning vary a lot based on market, investment beliefs, corporate culture. So if we move to our next slide, we're very aware that investors and corporates' views on tax vary significantly. And we think they can be broadly categorized into 3 buckets. On the first one is tax efficiency. Sorry, we need another click on the slides. And this is the simplest view, that the organizations that subscribe to this view tend to focus on tax as a cost, that should be minimized, as long as the tax planning is in compliance with the law. It's not a bad thing in itself, but it becomes problematic when aggressive tax planning is tolerated and actually encouraged. Then we have the tax responsibility element, which is what the PRI has been working on for the last few years, where we recognize that the impact of aggressive tax behavior has a long-term effect on shareholder value, and therefore it's undesirable from the perspective of good risk management. But we think tax fairness is a more expansive view. It recognizes the systemic nature of tax issues and the impact on the real economy. And here we're not talking about tax fairness towards an individual or even a cohort, a certain cohort like investors, but from the perspective of the collective. And we are not saying that businesses should not undertake prudent tax planning and assess tax risks, that's fine, but they should also give due consideration to the societal consequences in judging business success. So if we move to my next slide, we have a long-term vision for our tax program that is quite ambitious, and this is to facilitate a shift towards tax fairness in the market. We haven't found the definition of tax fairness, but we are starting from the premise that a fair and global tax system can only be realized when another click, sustainability goals and economic prosperity are achieved through effective tax revenue collection and distribution, when the opportunities for corporate tax abuse, be it evasion or avoidance, are eliminated, and this is where tax havens come in, and when the new global norms that we would like to see on tax promote integrity, transparency, and accountability, and that's amongst all participants in the system. What we do know for sure is that this is going to require commitment and actions from investors and companies that are at different places across the spectrum. And this brings us to my next slide. What does the PRI do on this? What have we done as an investor-led initiative? So since 2015, we have been raising awareness on the importance of tax as an ESG issue. It didn't make us popular for a long time, but we felt that we really had to have a voice in this debate. We have run several educational events. I think a few years ago, we were running the probably largest collaborative engagement by investors with their invested companies. It was a 3-year program focusing on companies in the healthcare and IT sectors, and we can discuss the results. Not sure if we'll have time today. And we have consistently engaged with standard setters and policymakers advocating for greater transparency. So what is it that we have been advocating for? What is it that investors want from companies? And we've narrowed this down based on significant conversations with our signatories. I'll keep it very short. The investors want to see commitment, good governance, and data. And I have some bullet points underneath. Again, I won't go into detail, but I want to highlight that our research has shown that corporate tax disclosure lags significantly compared to other ESG issues. And it's not perfect for other ESG issues, but here we have a massive issue. There is very weak evidence that companies are actively addressing risks emerging from tax issues, and that tax policies are linked to wider strategic objectives, including sustainability, which is very important for investors. And this lack of tax transparency means investors cannot ascertain companies' positions on tax, they can't identify leaders or laggards, and they can't validate commitments made by companies. So Jan, I hear you when you say transparency is only the first step, and yet it's such an amazing missing link here. Investors need more meaningful and granular data on tax to embed tax into their investment decision-making process. So they want to see global policies that actually outline position tax havens. They want to have confidence into risk management and governance approaches, and they want public country-by-country reporting. And I cannot emphasize this enough. In our next slide, I have highlighted some of the benefits both for investors and companies, and we know that it's now feasible. For us, it's a key area for policy intervention, public country-by-country reporting. It should apply to all companies over a certain revenue threshold. It should be based on the most recently audited financial statements and should be disaggregated. We are very supportive of the GRI standard 207 that we have actually been members of the technical committee there. We think it's a good format for disclosures, and investors should promote it. I'll move quickly to my next slide, just to maybe very briefly highlight what we're doing next. As an investor initiative, we focus on engagement, but now we're looking into voting. So actually making sure that investors own tax beliefs are translated into voting decisions when they are the company's annual meeting. We want to reinforce the link with environmental and social issues. We have a big program on human rights, and we're looking at tax from an inequality perspective there. We will continue to help investors contribute to the policy debate, and priorities include CBCR, but that's not the only one. Tax havens is a big question mark as well. And walking the talk, we're looking at our own, at our investors' own tax affairs. So we want to help them develop a model policy on tax, covering both themselves as investors and their invested companies. In my next slide, I just have a few resources that maybe the audience is interested in. I think the global trends in corporate tax disclosure have the disappointing results we expected when we commissioned the research. However, we do not let that deter us. It actually gives us more motivation to work on this issue in the years to come. And I think our latest discussion paper on tax fairness is where we have positioned ourselves and we really explain what does this mean for investors and what do we want investors to do. And I can tell you now that compared to 7 years ago, the momentum we have seen in the investment industry, how aware they are of tax as a sustainability issue has changed significantly.